You're down 12% over 3 weeks, and the question consuming you is whether your edge stopped working or whether you're experiencing normal variance. And this question feels urgent but cannot be answered during the drawdown because emotional pressure distorts analysis and sample size remains insufficient for statistical conclusions. The diagnostic you need has 3 components: execution rate, loss parameters, and market structure. And only when all 3 signal problems should you conclude edge is broken, while 1 or 2 signals suggest variance or execution issues, not edge failure. First component: execution rate above 80% means you're executing the edge correctly regardless of results, meaning the edge itself is being tested, not your ability to follow it. And if execution rate drops below 70% during drawdown, you have execution problem, not edge problem, and must fix execution before evaluating edge. Second component: losses staying within risk parameters means each individual loss falls within expected range, even though losses are clustering. So if your maximum expected loss per trade is 2% and losses are averaging 1.5%, losses are normal, just arriving more frequently than usual through random distribution. Third component: market structure remaining similar means the conditions your edge was designed for still exist. So if your edge works in trending markets and market has shifted to range-bound chop, edge isn't broken, it's misapplied to wrong environment, which is information problem, not edge failure. The diagnostic framework: if execution rate above 80%, losses within parameters, and market structure similar, you are experiencing variance, not edge failure, regardless of how drawdown feels, because all 3 inputs confirm edge is being executed correctly in appropriate conditions, and results are simply probability distributing losses temporarily. When one component fails, the diagnostic changes. Low execution rate during drawdown means fix execution first before questioning edge. Because you cannot evaluate edge, you're not executing, and drawdown might be execution failure, not edge failure. Losses exceeding parameters during drawdown means risk management problem, not edge problem, because edge can be valid. While position sizing or stop placement creates oversized losses, and fixing risk parameters might restore profitability without changing edge. Market structure change during drawdown means edge potentially misapplied, not broken, requiring either waiting for appropriate conditions to return or developing complementary edge for different market environments, neither of which means original edge stopped working. Only when all 3 pass and drawdown continues beyond statistical probability should you consider edge degradation. Execution above 80%, losses within parameters, market structure appropriate, yet results significantly worse than historical expectation over meaningful sample, which suggests edge may have degraded due to market evolution or strategy crowding. The critical insight: you cannot run this diagnostic during emotional pressure because emotional pressure biases each assessment. So you must establish baseline metrics during profitable periods and run diagnostic mechanically during drawdowns, comparing current data to established baselines without emotional interpretation. Pre-commitment protocol: during next profitable period, document your execution rate baseline, your expected loss parameters, and market conditions your edge requires. Then, during future drawdowns, run 3-component diagnostic against documented baselines and trust mechanical comparison over emotional assessment. Common mistake: concluding edge is broken after 20 trades because it feels broken. When 20 trades provides no statistical basis for edge evaluation, and feeling broken reflects emotional response to loss, clustering, not analytical assessment of edge validity. The uncomfortable truth: Most drawdowns are variance, not edge failure, and most traders abandon working edges during variance because they run no diagnostic, trust emotional assessment over data, and lack pre-committed criteria for distinguishing variance from genuine edge degradation. Your edge is likely not broken if execution rate remains high, losses stay within parameters, and market structure hasn't fundamentally shifted, meaning your job during drawdown is maintain execution quality, while variance resolves not abandon approach based on emotional pressure misinterpreted as analytical insight.